Welcome back to the deep dive. Today, we are putting on our structural analysis goggles.
We need them.
We really do. Because the financial market, specifically the late 2025, early 2026 outlook, is presenting a fascinating and, frankly, kind of a terrifying set of contradictions.
It really is a perfect storm of competing narratives. On one hand, you have record highs, right? All fueled by this genuine, palpable enthusiasm for the AI supercycle.
Sure.
But then on the other hand, the foundational historical metrics, ones that have always signaled profound risk, are flashing red brighter than ever before.
And that's really the mission of this deep dive. We want to unpack the sources that are detailing this profound structural fragility. We're moving past the daily news cycle to focus on these long-term alarms, metrics that have historically preceded what one source called significant capital destruction.
And we're talking about the big ones.
The big ones. We're drilling into the legendary Buffett Indicator and the cyclically adjusted P ratio.
And crucially, it's not just about the ratios. We have to connect those extreme valuation metrics to what's actually happening on the ground.
To corporate behavior.
Exactly. Why are these tech giants suddenly taking on massive debt? What happens if the foundational thesis of AI, this idea that scaling just always works, what happens if that starts to break down?
Okay, let's unpack this structural problem. We have to start with that 30,000-foot view.
The big picture.
Where do we even begin? Let's start with the Buffett Indicator. It's so simple, but so potent.
It's just the ratio of the total U.S. market cap to the gross domestic product.
And Buffett himself called it the best single measure of where valuations stand at any given time.
The logic is just so intuitive, right? Asset prices shouldn't massively and sustainably outpace the actual economic output of the country.
It just can't.
If the value of the stock market is, double the country's entire income, that value is speculative. It's not fundamental.
And the numbers right now are, well, they're just staggering. The historical mean for this indicator is comfortably between, 75 and 90%.
Yeah, in that range. Even at the peak of the dot-com bubble, which we all remember as just insane.
Total insanity.
It only hit about 153%.
Okay, so with that context, our sources are placing the current late 2025 reading at north of 215%.
It's statistically anomalous. I mean, that's literally 100 percentage points higher than the most aggressive speculative period of the last century.
But you always hear the counter-argument, and it's a legitimate one.
Of course, structural shifts.
Right. Critics say, look, U.S. companies derive massive revenue overseas now. Think Apple, think NVIDIA. That revenue isn't counted in U.S. GDP.
And that's true to a point. But the question is, does it explain this massive deviation?
It sounds reasonable on the surface. Shouldn't the ceiling be higher now than it was in the 80s?
It should be, and analysts account for that. They use these sophisticated detrending techniques to essentially give the market the benefit of the doubt for globalization and other changes.
So they adjust the baseline upwards.
Exactly. But even when it's detrended, the current valuation is still over 56% above its long-term average trend line.
Wow. So even with a generous statistical filter, we are still dramatically overvalued.
Dramatically. The deviation is so high, we're talking nearly 2 standard deviations above the trend, that the globalization argument just can't credibly explain it all away.
So what does explain it?
Speculation. Pure speculative pricing, especially in those mega cap tech leaders, that's what can explain a gap of that size.
That is a crucial insight. And, if you're keen on tracking this total market temperature yourself, there's actually an iOS app called Buffett Indicator in the Apple App Store. It gives you real-time alerts on where we stand against these norms.
It's a very useful tool to have.
It really is. Okay, so for market cap, let's move to earnings with the Shiller PE, or the Co-PA ratio.
Right, and this one is powerful because it smooths out the business cycle by averaging real earnings over 10 years.
So what warning is this key PE ratio issuing right now?
Well, the CPE ratio currently stands at approximately 39.
39. And the long-term historical averages?
A very modest 17.7. So we are trading at a premium of 120% above the historical norm.
That puts us right back in the territory of only 2 other periods in history.
The dot-com peak, which hit 44, and that brief, wild post-pandemic peak. That's it.
And the utility here isn't for short-term timing, right? It's for forecasting.
Exactly. And when you start at 39 times earnings, the forecast is just bleak. Regression models project 0 to nominally positive returns, maybe 0.5% annualized for the S&P 500 over the next decade.
0 real returns for 10 years.
Yeah.
That is the literal definition of a lost decade for investors.
It is, and the historical record here is brutal. The S&P 500 has never not once produced a positive 10-year inflation-adjusted return when purchased at PE ratios of this magnitude.
So anyone entering the market today is facing just immense statistical headwinds.
They're betting that this time is different in a way that just fundamentally breaks 100 years of data.
Of course, the optimist points to the forward PE. It's lower, around 23 times.
Which is still way above the 16 times historical average. And it's only 23 times because analysts are projecting this extremely aggressive 12 to 14% earnings growth for 2026.
Which all assumes a near-perfect AI execution.
Which feels incredibly fragile.
That fragility, it leads us directly to the bond market. For a record 16 months, the yield curve was inverted, signaling a recession.
The classic warning sign.
And recently, it finally uninverted. So is that good news?
You'd think so, but when you look at the historical timing, it's the opposite of good news. The inversion is the warning, but the uninversion. That's often the transition point. It's the execution phase.
What do you mean by that?
Historically, the recession or the financial distress tends to begin shortly after the curve uninverts and steepens, usually within about 3 to 6 months.
And we are in that window right now.
We are squarely in that window.
And the nature of this steepening is crucial, right?
Yeah.
Is this a healthy one or a toxic one?
This is emphatically a bear steepener. The spread is positive now, yes, but the driver is the long end of the curve, the 10-year yield rising faster than the short end.
And why is that happening?
It's being pushed up by concerns over rising term premiums, persistent inflation, and maybe most importantly, these massive U.S. fiscal deficits.
Okay, so break that down. Why is that specific type of steepener so poisonous for stock valuations, especially for tech?
Because the 10-year yield is the baseline risk-free rate in every valuation model. When that rate rises, the present value of all those future cash flows, all that revenue promised by AI companies years from now, it just falls dramatically.
It's like gravity.
It's the gravitational pull on an already ballooning valuation. It makes every stock instantly worth less no matter how well the company actually performs.
So, if the macro picture is this dire Buffett indicator screaming, KPE forecasting a lost decade, yield curve in the execution phase, why is the S&P 500 still near record highs?
That's the paradox.
You even see it in the CNN Fear and Greed Index, which is sitting in neutral to fear. Makes no sense.
This is what some are calling the hated rally. The divergence here suggests immense structural fragility. Institutional investors have severe FOMO fear of missing out.
They have to participate.
They have to. They have benchmarks to hit. But they aren't buying with conviction. They're simultaneously buying massive amounts of downside protection in the options market.
Which is why the put-call ratio is so bearish.
Exactly.
Yeah.
That and junk bond demand remains skeptical, and it pulls the whole index down into fear. So you have strong momentum in a few stocks, but huge hedging and credit market skepticism right underneath the surface.
It confirms the rally is narrow.
Dangerously narrow. It's standing on a needle point, supported only by a few mega-cap AI leaders. If one of those leaders falters, there is no broad base of support waiting to buy the dip.
So let's tie these macro fragility signals directly to corporate reality.
Yes.
We need to look at the specific behavior of the companies driving this whole rally. And the Oracle case study is, it's a perfect microcosm of the problem.
Absolutely perfect. Here you have Oracle, a long-standing, very profitable company. They beat their earnings estimates, and the stock plummets 11%.
And it wasn't a revenue problem. It was the cost of growth.
The cost of AI demand. They announced they're increasing their annual CapEx budget from $35 billion to a staggering $50 billion.
$50 billion, just to build out their cloud infrastructure for AI.
And this just perfectly encapsulates what we call the financing phase of this AI boom. They can't fund that massive outlay from their current cash flow.
So they have to borrow.
They're forced to aggressively increase their already significant debt burden to finance future anticipated revenue.
Oh.
And the market reacted so negatively because in a high-rate environment, which the bear steepener confirms we're in, debt-fueled growth becomes extremely risky.
The market is questioning the ROI on that $50 billion. And that brings us to the existential risk in the whole virtuous cycle of AI.
The cycle we're all relying on to justify these valuations.
Right. It's simple. Hyperscalers buy chips, train models, generate revenue, reinvest.
But what if the output no longer justifies the input? The sources cited some key comments from OpenAI co-founder Ilya Sutskever,
who's a true pioneer in the field.
A true pioneer. And he's expressed skepticism that simply making models bigger, just relying on pure scaling laws, is still yielding proportional returns.
So if the improvement from say GPT-5 is only marginal compared to the massive cost increase over GPT-4,
Yeah,
the whole economic argument just collapses.
it does. If scaling efficacy stalls, those massive debt-fueled $50 billion capex budgets become immediately unjustifiable. Hyperscalers slam the brakes on chip orders and you get a sudden cascading crash across the entire tech stack.
And the economic consequence here is the central and, frankly, terrifying insight from the sources we looked at.
It's the concentration.
Tell us exactly what the sources found about GDP concentration.
The analysis is startling. It found that virtually all of the estimated 2% GDP growth for the U.S. in 2025 is attributable to hyperscaler AI capex.
Wait, say that again? Virtually all of the expected GDP growth.
All of it. Think about that. Without these few companies aggressively leveraging up to buy chips and build data centers, U.S. GDP growth could instantly revert to zero or negative.
That is just an incredible reading. We're essentially betting the entire U.S. economic narrative, not just the stock market, on the continued cost-effective scaling of large language models.
It is the absolute definition of systemic concentration risk.
And it makes that forward PE of 23, based on 12% growth, look extremely vulnerable.
Because if those capex projects suddenly look marginal, that earnings growth disappears overnight.
And this concentration risk makes the weakness outside the AI trade even more alarming.
Right, because it shows the rest of the economy is already struggling under the weight of those high long-term rates.
Let's look at housing and the consumer. It just confirms the toxicity of that bear steepener.
High long-term rates have effectively frozen the housing market. Look at the signals. A luxury home builder like Toll Brothers reported decent revenue.
But the forward-looking metric, the backlog of future orders,
was down a significant 15%. They're cutting their margins, offering incentives just to move properties.
and Home Depot, the bellwether for the consumer, they issued 2026 EPS growth guidance of only 0 to 4%.
Which was a big miss. These data points confirm that the activity that drives real GDP construction, renovation, transactions, it's stalling. This structural weakness is just being masked by the AI capex boom.
Okay, and finally, let's briefly touch on the chaos in the media landscape. We're seeing this merger of survival frenzy.
Specifically, the bidding war for Warner Bros. Discovery.
Right. Netflix is reportedly offering $83 billion, mostly to get their hands on HBO's content library.
This kind of M&A frenzy is characteristic of an industry in the desperation phase. They're just trying to consolidate to survive against the tech giants.
But a Netflix-WBD merger would control 35% of the premium streaming market. That faces huge antitrust hurdles.
Massive hurdles. And the sources also noted the executive behavior here, sharply criticizing WBD's CEO for his high compensation even as the company's value languished.
It's a sign of misaligned incentives.
A key sign of underlying sectoral stress, yes.
So let's bring this all together. What does this all mean? We have the foundational quantitative warnings.
The Buffett Indicator way beyond historical bubbles.
The CPE ratio predicting a decade of zero real returns.
Converging with these profound qualitative vulnerabilities. The debt-fueled, highly concentrated AI growth.
And the uninversion of the yield curve confirming the timing. The clock is ticking.
And it all leads directly to this air pocket scenario for 2026. The consensus expects aggressive 12 to 14% earnings growth.
But there's a timing mismatch.
A huge one. The massive capex hits the income statement as depreciation now. But the AI revenue that's supposed to pay for it might be delayed, or it might never fully materialize if scaling stalls.
And if those hyper-optimistic revenue targets are missed, the market faces a vicious double compression.
Exactly. First, earnings fall because of the capex hitting the books. And second, the PE multiple contracts dramatically as investors flee.
And that combination implies what kind of correction?
A correction of 30 to 40%, just to revert to a still expensive PE ratio of 25 times. The uninversion of the yield curve is the final warning bell. It confirms the goal has to shift from growth maximization to simple capital preservation.
That's a powerful and sobering synthesis. So we've established that AI capex is the primary engine supporting nearly all of U.S. GDP growth next year. If the most critical data point for the 2026 global economic narrative is the performance of the next generation of LLMs, what happens if the scaling laws break?
What happens if the massive cost of training GPT-5 and beyond yields only marginal improvement?
That failure.
That is the true systemic concentration risk facing the global economy right now. That's the question we'll all be facing in the months ahead.
Thank you for joining us for this deep dive into structural fragility. Please remember, all analysis is based on publicly available sources and is for educational purposes only. It does not constitute investment advice. Be sure to conduct your own due diligence before making any investment decisions. If you want to listen to our full deep dive about this topic or access more advanced content, you can join the Deep Value Club membership or subscribe to us on Apple or Spotify podcasts. See you next time.